IFRS number 2. Great. Now, when we talk of IFRS 2, what comes to our mind? IFRS 2 talks about what we call the share-based payments. The share-based who? The share-based payments. Share-based payments. The share-based payments. Share-based payments. Share-based payments. Now, please listen and listen to me very well. You see, you realize there are some good employers in this world. These great employers, what will they do? What kind of arrangement will they have? These great employers, what they will do, they will, at the end of each year, perhaps in this case here, give employees some shares through what we call employee share ownership plan. Employee share ownership plan. So, for example, as senior management, when you get into a company like this, these people, for them to motivate you to work extra hard, what they'll do, they'll tell you, hey, if you stick around with us, say for how many years? Say for 3 years. Say for 3 years. And then, of course, they'll give you other conditions, like, for example, the profit should be growing up to this level. Then we shall be able to give you the company's shares. We shall be able to give you the company's shares. So if the company will be giving shares, listen here, if the company will be giving its ordinary shares, we talk of ordinary shares, or some other payment, it could be cash payment, but pegged on the share price. Pegged on the share price. So in this case here, these executive managers, they are told here that you guys stay with us for a minimum of 3 years. And if you do that, and then it happens that our share price has risen, say, to 40 shillings, then we shall be able to give you a bonus of this amount. We shall be able to give you a bonus of this amount. So the amount, which is cash, is pegged on share appreciation. So in this particular case, ladies and gentlemen, in these particular 2 cases here, automatically, if payment of a company is done by giving either an employee or a supplier of goods shares of the company, or in this case here, we get a way of motivating this staff to work very hard, and then we promise some cash, which is pegged on the performance of the shares, then when it comes to us, ladies and gentlemen, accounting for the 2 scenarios, we shall be accounting for the 2 scenarios under IFRS 2. Under IFRS 2. You guys, are you able to see my board? Are you able to see my board? Cheriot is saying the board is not clear. How about from the other students? Are you able to see my board? Are you able to see my board? Yes. So perhaps it could be internet from his side. Great. So I have notes with me here that I would want to share with you. And this is going to be a very short class. You'll be surprised. Less than 20 minutes. So you're told here IFRS 2, share-based. It's called share-based arrangements. Share-based payment. So we are told here what is share-based payment transaction. Does your company remunerate its top management by granting them its shares? Or do employees receive bonuses based on the increase in the company's share price? If yes, then your firm is making share-based payments, and as such, IFRS 2 must be applied in your financial reports. The share-based payment transaction is a transaction in which an entity receives goods or services from the supplier. It would be a supplier of services who is the employee, including employee, in a share-based payment arrangement, or it incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services. Forget about number 2 for now. For now, the definition that I want you guys to appreciate is definition number 1. Share-based payment transaction is a transaction in which the entity receives goods or services from a supplier. We have received the goods or services from a supplier, including employees, in a share-based payment arrangement. You've given us your services, you've given us your goods, but we shall give you shares. We don't want to pay you money. We shall give you shares in return. Then we should be able to apply IFRS 2 in our financial reports. We are told the condition here is that your company must be receiving goods or services, and in return, the company gives the suppliers of those goods or services its own shares. Or number two, cash based upon the price of its own shares. Quite clear. There are three types of share-based payment. These are, we have number one, ESS, what we call the equity settled share-based payment. This is where the company pays shares in return for goods / services received. So under equity settled, we shall settle this obligation by giving the supplier of services or goods our company's shares. It's called equity settled. Equity settled. Great. And then number two, ladies and gentlemen, we are told here cash settled share-based payment. This is where cash is paid in return for goods and the services received. However, the actual cash amount is paid based on the share price. These are also known as the SARs, the share appreciation rights. Great. Now listen here, number three, then we have got a transaction with a choice of settlement, where in this case here, you tell these guys, you've provided your services, you provided your goods to us, please choose. Do you want shares? Do you want, in this case here, cash? At times it's called hybrid, share-based payment, hybrid. Because at the end of the day, in these situations where we're giving these people a choice to make, at the end of the day, some of them will tell you, hey, give me a few shares and some cash. So at the end of the day, they have combined. But now there is something that I would want to be very categorical about as we do this discussion. As we do this discussion, ladies and gentlemen, there is something that I would want us to be very categorical about. What is this? That generally, the general concept is that the share-based payments are actually two. That is the general principle, leave alone the hybrid. There are two. Which ones are these? We have in this case here equity settled, a share-based payment. And then number two, we have cash settled, where we are going to give what here? Cash at the end of the day. So cash settled, share-based payment. Remember, this cash settled share-based payment can only fall under IFRS 2 if the cash, the bonus you're going to give these employees is pegged on the performance of the share, is pegged on the shares appreciating, what we have called the share appreciation right, the SARs. Now listen, they want us to master this concept of double entry. When they talk of double entry, I always remember what we call the famous PALs. I always remember what we call the famous PALs. Is there anybody who has ever come across this acronym PALs? Is there anybody who has ever come across this acronym of PALs? Is there anybody who has ever come across this acronym of PALs? PALs? Yes. I can see Sharon there. Sharon Nasema, yes. Yes. Great. Yes. Great. Great. So PALs, ladies and gentlemen, stands for what here we have purchases, expenses, and assets. Purchases, expenses, and assets. Whenever they increase, we shall be debiting. Whenever they increase purchases, expenses, and assets, whenever they increase, we debit. And then we have revenue, liabilities, and share capital. These three. Whenever they increase, what do? We credit. we credit. Now, ladies and gentlemen, remember, either way, we are going to have an expense for the company. Even if you pay these employees in cash or in form of what year or in form of shares, they have worked for us. So there is an expenditure, there is an expense here, there is a labor cost. So either way, the expenses here will be debited. So I'll be debiting expense here, and here I'll also be debiting expense. Now the difference comes on what do we do to the credit of our ledgers. Credit of our ledgers. Thanks. Our area is revenue, like sales revenue. Sales revenue, liabilities, and the share capital. Sales revenue, liabilities, and the share capital. Those ones here must be done what year? They must be credited. Those ones must be credited. Those ones must be credited. Thank you so much. Now listen. Equity means that you have done what? Equity means that you have given new shares to employees. It means that your share capital has increased. Your share capital has increased. So in this case here for equity settled, the share capital is here. You shall credit the share capital, the ordinary share capital account. Now, ladies and gentlemen, please listen. For cash settled, normally what we do for cash settled, what we are doing every year, we are accruing the liability. We are accruing a liability. Remember, we shall pay them, say, in the third year. When, for example, some obligation has been met, some vesting condition has been met, third year, for example. So then every year, what shall we be doing? Because we owe them, then automatically we shall be crediting what year? The employee liability. Just mentioned there, we are crediting liability. So that at the end of the third year, when we shall be paying them, we shall debit liability, and then we credit cash or a bank, depending on the mode of payment. But for now, these are the kind of things that I would want us, first of all, to appreciate. These are the kind of things that I would want us, first of all, to appreciate like this. So first of all, I would want to know whether up to here, are we together? Are we together? Don't worry about so many notes because I'll share with you this handout. But up to here, in terms of understanding, right? Are we really somewhere basking in this sun together? Thanks, Martin. Right? So very important, JN. Great. The only thing that you guys haven't yet done for me, we agreed that we are giving Mwalimu more than 100 students. I'm happy at least now we are almost a half, but you see, we can do better. What you need to do is basically to share this Zoom link with your friends. After all, whatever I'm giving you here is a world class, because I always tell you what I do at my workplace. At my workplace, we are IFRS consultants, and we do consultations on matters of IFRS to global companies like Sony International, etc. So this, I'm teaching you the practical aspect, world-class training. You need to bring these people to come and at least get this, what I would call a great cup of coffee for free. Great. So I believe in the next 20 minutes, we should be over what year? Over 80, because you guys are going to take a step over inviting your friends. Great. So here we are, and now we are going to a very important section. Before I look at a question, a past paper question, this is what I would want us to understand. The concept of vesting period. Are there men nowadays who still put on vests? Are there men who still put on vests? Yeah. The dynasty, isn't it? Great. No, I'm joking. So vesting period. Often share-based payments are not immediate, but payable in, say, 3 years. We'll promise these guys because we want them to work very hard. We don't want to give lazy people our shares, our company shares. We want to give, in this case here, people who really deserve, who have worked so hard for us. So we shall give them, in most cases, a minimum, a promise of giving them shares, say in 3 years, in 5 years. The expense is normally spread over these 3 years, and this duration is called the vesting period. It's called the vesting period. And they are telling us something very important here in terms of recognizing that always you shall debit expense and then credit equity or liability depending on which share-based arrangement do you have. Which share-based arrangement do you have? Now listen and listen to me very carefully. Listen and listen to me very, very carefully. I would want straight away to look at something very, very important. There is something very important here that I would want you guys to appreciate. Yes, 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 yes. I would just want us to skip a few things here and there, but there is something very important. If you guys are writing your notes, I would want you to write this. I would want you to write these two lines, that for equity settled, use fair value of shares at the grant date. For equity settled, use fair value of shares at the grant date. For equity settled, use fair value of shares at the grant date. And then for cash settled, update the fair value of shares each year. This is what I would love you guys to write. And I would want you guys to write this as a note, that for equity settled share-based payment, we shall use fair value of shares at the grant date. For equity settling the shares, we shall not be having a fair value. The market value of our shares will not be fluctuating between the years. We shall only work with one fair value, which is the fair value as at the date when we made this promise, as at the date when we granted this promise here. So we are basically saying that the value here, the fair value is constant. The fair value is constant. That is for equity settled. How about for cash settled? So for cash settled, we shall use fair value of shares prevailing at the end of each year, and therefore, what do you know about the fair value of these shares? If it's fluctuating like that, if it's changing like that, at the end of each year, of course, we expect the fair value to fluctuate. So in this case here, fair value will fluctuate. Fair value will do what here? Will fluctuate. The fair value will fluctuate. So have you written this note very well? I've written this note very well, and if possible, please highlight. And I would want you to highlight with the color of your political party. If you're Azimio blue, if you're UDA, in this case, you're yellow. I'm joking. We are now beyond that. We are beyond that. The most important thing is to ensure that this thing sticks in our minds. That when we talk about this is a promise of shares or share options. If it's share options, what do? We look at the fair value as at the date when we were granting this promise. That fair value is what shall be used throughout, in our analysis. If it is cash settled, what we have also called share appreciation rights. If it's cash settled, share appreciation rights, then the fair value of the shares that shall be fluctuating. Great. Now that, ladies and gentlemen, then takes me straight away to an illustration. That takes me to an illustration which is here. This illustration I would want us to do. An entity grants 100 share options on its $1 shares to each of its 500 employees. On which date? 1st January 2022. So this is when we are granting. This is when we are making the promise. So if I were you, and this happens to be an exam paper, I will circle this 1st January 2022 and say straight away that this is what year? This is my grant date. Each grant is conditional upon the employee working for the entity over the next 3 years. 3 years. So the grant, or rather the vesting period, is 3 years. The fair value of each share's option as at the date of grant is $10. Fair value as at the grant date, I must circle this because I know this is a question of constancy. This is a question of constancy. The fair value as at the grant date 10 is what will be used throughout in each of the 3 years. This is what, here, what have we granted? We have granted these guys here share options. We haven't granted them, promised them cash. We have granted them shares. And if it's share options or just shares, then this becomes equity settled. And if it's equity settled, ladies and gentlemen, then the fair value as at the grant date will be known and shall be used without any changes moving forward. We are told based on weighted average probability, the entity estimates on 1st January that 100 employees will leave during the 3-year period and therefore forfeit their right to share options. The following actually occurs. We are told that 20 employees leave during 2019, and the estimate of total employee departures over the 3 years is now revised to 70. But number 2, 25 employees leave during 2020, and the estimate of the total employee departures over the 3 years is now revised to 60 employees. Not 3, 10 employees leave during 2021. So what they would want me to do, ladies and gentlemen, here is to account for these transactions, under IFRS 2. Under IFRS 2. This IFRS 2 is very popular with your examiner. Very popular, we'll see. Let me just do this illustration, and then we go to the past papers for you guys to be able to see what I'm talking about. Share-based arrangements. Very easy question. I'll get all the marks even without knowing what I'm doing. And really, that is it. Because for us here, what matters most is you passing, right? Passing is what we want. The end justifies the means. So then how do I start doing this IFRS 2 financial reporting? It's very easy. It's very easy. What I will do, first of all, I look at the employees who shall wear the vest. The employees who shall remain with us are the ones who will benefit out of this share arrangement. So then I'll come and write a big title here, employees left. Employees left. So employees left. So we have here employees left in the organization. So we have got 3 years. Which years do we have here really? We've got 3 years. The 3 years are here. So we have which year? 2019, 2020, 2021. So we have 2019, 2020, 2021. Remember, when we began, ladies and gentlemen, we began with how many employees? This scheme. In this scheme, we had 500 people. An entity grants 100 share options on its 1 share to each of its 500 employees on this date. So we began with 500. Let's check the movements. Let's check the movements here. We are told the following actually occurs. We have 20 employees leaving, 20 employees leave during 2019, and the estimate of total employee departure over the 3 years is revised to 70. Listen, the key thing is here, that the total people to leave on the first year, they are 70. Then that would mean that the people will be left behind will be 500 minus the total of 70. minus the total of 70, which gives me what here? 430. There is another school of thought. Somebody will tell you, why don't you do this? You say 500 minus the actual number that left in the year, minus the actual number that left in the year, minus what they call further, the extra employees who are expected now to leave in the future. The extra employees who are expected to leave in the future. So remember, the total to leave as of first year, the total we expect shall leave are 70, of which we are told out of the 70, 20 have already gone. So now we are left with this excess further 50. If that is what you would want, you can say like that. So 500 minus 20 minus 50 will still give you 400 what year? 430. I would want to repeat this, ladies and gentlemen. I would want to repeat this, ladies and gentlemen. This is what I would want you guys to understand, because the moment you've understood this freely, you have understood everything. They are telling us 20 employees leave during 2019. And the estimate of total, please, the key word is here. They have not told you estimate of further. It is estimate of the total employee departure over how many years? Over 3 years. Is now revised to what? To 70. Is now revised to 70. Right? So meaning that for sure, I can even choose to turn a blind eye to these 20 who actually left for now. Whenever they mention the word total, then straight away, let me check the charts here. Let me check the chart. Okay, great, thanks. So in this case here, the total is 7. When they mention total, always work with total. Now look at note number 2. I love now note number 2. So note number 2, we are told 25 employees leave during 2020. And the estimate of total employee departures over the 3 years is now revised to 60. Trust you me. This is quite confusing, but very easy. Trust you me. They have given you the total to leave over the 3 years as 60. A good student will tell you, when they give you the total to leave over the 3 years, always work with that total. Work with that total. Then what should we do? We should come here, ladies and gentlemen, and talk of 500 minus what here? Minus the total to leave over the 3 years. 500 minus 60. So 500 minus 60, then this will give me 400 and what here, somebody? If you wish, you can come and do what here, expound on this. If you wish, remember this is just optional. You'll get other students telling you, Mwalimu, why don't we talk of actual? So when we talk of actual, then what that would mean is that you come and pick the actual number that left in year 1. Remember, year 1, we lost 20, minus the actual number that will live in 2020. The actual number to live in 2020, the actual number to live in 2020, the actual number to live in 2020 is 25. So minus 25, minus 25. But remember, if you're using this approach, then you must recall very fast the concept of it is the total people will exit over the 3-year period that you are accounting for. The total. So these are the actuals that have left in these 2 years. But remember, we are accounting for how many years? 3 years. So we must always talk of a further. So remember, here you have accounted for 45 in total. 45 in total, and we know that 60 are supposed, in this case here, to disappear over the 3 years. So it means that this concept of further, if we have accounted for 45, then we have a 15. But I don't know why people would really want to go through all these hassles. The moment they mention the words there, a total of 60 will disappear. What I'll do, I'll go back to my first principles. It's about estimations, right? Things keep on changing. So I must always begin with the original number, 500. So 500 is what we expected, or rather is what we had as at the start of this scheme. 500, and then we have a total of 60 leaving. So this gives me 440. Now we come to the last year. Remember, the vesting period was a period of how many years? Was a period of 5 years, or 3 years, I mean. So in the last year is very interesting, because the last year we normally work with the actuals. So the last year, we normally work with the actuals. Last year, we don't work with any estimates, because now we know vividly what has taken place. So we are told here, year number 3, 10 employees now leave during 2021, right? But remember, I would want to account for all the employees that now actually left over the 3 years. So remember, we are 20 leaving in year 1, we are 25 leaving in year 2, and then now we have 10 leaving in year 3. 10 leaving in year 3. So then could you kindly give me this total? Is there somebody who can be kind? Once you understand this, you'll become so good in this concept here. Could you kindly give me now this 500 minus 20 minus 25 minus 10? What are we getting, somebody? What are we getting, somebody here? 500 minus 20 minus 25 minus 10. So Sharon gives me 445. 445. Now I would want to repeat something very small here. 445. I would want to repeat something very small here. And this is what I would want us to do. Remember, we began with how many people in total? We began with 500. So at least I'm aware that it's important I'll have here 500, 500, 500. Minus. All right. Now listen and listen to me very well. What do we have, ladies and gentlemen, here? What we have here, they have told us 20 employees in year 1 leave during 2019, and the estimate of total employee departures over the 3 years is revised to 70. So because they have mentioned the word 70 total, then I'll use that 70. I'll disregard this actual for only 1 year because the vesting period is 3 years. So minus 70. Then we go to year number 2. So year number 2, what do we have here? 25 employees leave during 2020, and the estimate of total employee departures over how many years? 3 years is now revised to 60. So I'll talk of 500 minus 60. 500 minus 60. When I come now to the last year, which is the year of vesting, they have told me that 10 employees left during 2021. But now I know the last year is the year of deducting all the actuals that left in all these years. So I know the actual year for year 1 was 20. So I subtract 20 there. I subtract 25 who left in year 2, and then 10 who left in year 3. And of course, Sharon has told me that this is 445. The first one is 530. The second one is 430. This is 440 like that. 440 like that. Great. Now please listen and listen to me very well. Please listen and listen to me very well here. They have given us the number of shares that we are going to give each employee. Number of shares we're going to give each employee. They have done that. I'll come back to your question, Willie. They have told us, what they have told us here is that an entity grants 100 share options on its 1 share to each of its 500 employees. So each, ladies and gentlemen, each person who remains in the organization will be given how many shares? 100 shares. So we have here times 100, times 100, times 100. From there, we'll come and change this to money. How do we change this to money? This being an equity settled payment, I would want the fair value at the grant date. The fair value at the grant date. The fair value at the grant date. So have they given us this fair value at the grant date? 1st January 2019 was the grant date. 1st January 2019 was the grant date. Nope, this is an issue. This is supposed to be 1st January 2019. So that we talk over the fair value of each share as of 1st January 2019 was 10. So 1st January 2019 is the grant date, and therefore the grant fair value is this 10. So this 10 is what I'll use consistently when I'm changing this to money. So now I'll come and talk of 10 times 10 here, times 10. And then now we go to the last step. The last step is the one of time apportionment. Time apportionment. If these guys, of course, by the end of this 2019, these guys have stayed with us for what year? For 1 out of the 3 years in the vesting period. By the time they hit here, they have stayed with us for how many years? 2 out of 3, right? By the time they hit here, then they will qualify to get everything 100%, 3/3. So then could you kindly give me these figures before I go back explaining the question that I've seen so many guys asking here? Please give me this cost. Give me these expenses. All right, like the first one will be 430 times 100 times 10. Whatever we get times 1/3. Times 1/3. Please give me an answer. This thing will become very nice. This thing will become very nice. This thing will become very nice. Just give me an answer. Give me an answer. So we have 430 times 100. 100 are the shares that each employee was promised. Times 10 is the fair value. And this fair value has to be what here? Has to be the same, constant. Why? Because this is an equity settled. This is an equity. So I'm being given by Martin and Sharon 143, 333, 143, 333, like that. How about the second one? 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 Somebody would want to get answers from as many as possible. As many as possible. So Willie tells me it is 293, 3333. 293, 3333, like that. And then the last one is so nice. The last one is so nice. The last one is so nice. Margaret Mombi, fine. Stephen Ouko tells me that the last one, Mwalimu, is 445,000. 445,000. Now, ladies and gentlemen, please come and give me the annual change. The annual change. The difference. Remember here for year number 1, I'll come on top of 143, 333, like that. Because I'm starting from 0. How about this one? The difference between these two, the change. Take 293, 333 minus 143, 333. What are we getting there, somebody? What are we getting there, abracadabra? What are we getting here, abracadabra? The change. Sharon tells me the change is 150,000. 150,000. And then the last one, this change here. This change there. The last one, this change. The last one is the change. Is the change of how much? The last one, before I make this thing better and better, 445,000 minus 293, 3333. What are we getting here, somebody? What are we getting here, somebody? Abracadabra, I'm being given a figure of 151,667. 151,667. Oh yeah, if you remember, this change is your expense account. This change is your expense account. These are the amounts that will go to your income statement each year. So for 2019, I will debit my income statement with this labor expense. 2019, I will debit. This is the expense. So these figures here will be debited in the respective debit expense. That is what we said. Debit expense. Debit expense. Debit expense. Debit expense. Debit expense. All right. And then now, ladies and gentlemen, these figures that you're seeing here now automatically will be the ones, in this case here, to go to your balance sheet. Balance sheet. When we talk of these being equity settled, if it's equity settled like you're paying shares, so we know that equity, if you have debited expense, equity, then we shall be crediting what here, somebody? We shall be crediting the ordinary share capital account. So Nandika for credit, ordinary share capital account. We shall be crediting our ordinary share capital account. Share capital account. We shall be crediting our ordinary share capital account. So then listen, what are you talking about, Mwalimu, here? So what I'll do in practice is this. What I'll do in practice is this. So I'll go to the year 2019. I'll go to the year 2019. I'm being told by Willie that year 3 change is supposed to be 156. Is that true? If you take this and this 445,000 minus 293,333, can somebody confirm? Willie is disagreeing with this figure. Willie Velma is disagreeing with that figure. Willie Velma is disagreeing with that figure. Will Velma is disagreeing with that figure. Is there somebody who can confirm, please? Is there somebody who can confirm? Willy wamekataa, wamesema it's 151. Sasa angalieni hapa. Thank you so much. So nikienda 2019 abracadabra, nitasema debit, income statement, debit expense, it's a labor expense I'll be showing you. And then I'll say credit, ordinary share capital. I'll say credit, ordinary share capital, credit, ordinary share capital. So the expense here is this. It is 143,3333. This is 143,3333, like that. That's 2019. And then the same with the 2020. The same with the 2020. 2020, I'll come and debit expense, and then I credit share capital. I credit share capital. How much amount? The same figure. 150,000, 150,000, 150, 150. The same. And then you continue like that, So the biggest thing here is for us to appreciate that this is an equity settled. And if it's equity settled, I'll be debiting my expenses as I credit what here somebody? Ordinary share capital. As I credit ordinary share capital. Sasa mtanisamea kidogo. I will not be able to really dwell on how I got these numbers of employees left at this juncture. I would want to do another question for me to derive how I got number of employees left there. And I believe by doing that, we shall be able to connect between the two and, of course, understand it even better, understand this concept even better. So if you allow me, straight away, I will come and look at this question here. If you allow me, this is the question. You can see the answer is supposed to be 151,700. They were rounding off to whole numbers. If you allow me, this is the question that I would want us to do now. This one here. I'll share with you this handout, so please don't panic at all. So you're told here, 1st January year, 100 share appreciation rights. A good student, upon hearing these words, share appreciation rights, will always tell you that this is a cash settled. Right? We don't want to give you the shares. Once the shares appreciate, we shall give you a bonus, a bonus which is paid in cash. 100 share appreciation rights given to each of the company's 1,000 employees. The fair value of this at the grant date was $5. So fair value as at the grant date becomes irrelevant. If it's cash settled, we don't want fair value at the grant date. If it's, ladies and gentlemen, if it's cash settled, then fair value at the grant date is hot air. Fair value at the grant date, if it's cash settled, if it is share appreciation rights, then fair value at the grant date is hot air. That's how you cram this. All right. The employees had to be in service for how many years? For 3 years to take the share appreciation rights. All right. End of year 1, 100 employees had left, and 140 more were expected to leave by end of year 3. The fair value of the share appreciation right as at the end of the year 1 was $6, like that. And then now we are here, end of year 2, 40 employees left in the year, and another 50 are expected to leave in the year 3. Their value is now 8. End of year 3, 60 employees left, and the fair value of SAR is now $7. So, ladies and gentlemen, I would want you guys to do me a favor and try over the 3 years, try to tell me how many employees are left at the end of each year. How many employees are left at the end of each year? How many employees are left at the end of each year? Abracadabra. This one I should give a present. All right. How many employees are now left at the end of each year? If you get this correctly, we should be able to give you guys are present, because this is really the backbone of this IFRS. This is the backbone of this IFRS. This is the backbone of this IFRS. So write for me, tell me in year 1, how many are left? Let's see. Year 1, how many are left? Year 1, year 2, and then we have year 3. How many are left? How many are left? How many are left? Don't fear anybody. Please just throw your figure. Throw your figure. Throw your figure. You can see from here. You can see from here. 100 employees are left. Remember, in total, we began with how many? We began with 1,000. We began with 1,000 employees. And then you are told year 1, 100 left. 140 more. So year 1, what do we have? Let me see your answers. Total employees are how many? 1,000. 1,000. 1,000. Martin Kiunguti says 760 are left. I like that kind of brevity. Students who are brave are good. You must be brave. You must be brave. Let's see. 760, right? 760. Thank you so much. Now, we are told here we had 1,000. 1,000 in year 1. And then we have 100 living in year 1. And then our father, so minus 140, because really for us is to account the number of people who left over those 3 years. Over the 3 years. Thank you very much. So I believe that 760 is very correct. The 760 is very correct. Let's see now who will be able to get the numbers left, employees left. We call this employees left. Employees left. Employees left now for year number 2. In year number 2, how many guys do we have who are now left? If you get this, you're a genius. If you get this, you're a genius. End of year 2. So end of year 2, what do we have? Let's see here. End of year 2, what do we have? They're here. End of year 2, let's see how many will they get who are left in this company. In this company, 40 employees left in the year, and another 50, another or further 50 are expected to leave in year 3. So how many do we have who are left in year number 2? How many do we have who are left in year number 2? Now they don't want to talk to me. 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 They don't want to talk to me now. I don't know. 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 I can see 2 of them have chosen to talk to us. So we have a 10. Like you can see, these are great students. Students who come up with debates. Yeah, that's democracy, right? Debates. Debates. Now, ladies and gentlemen, please listen. And this is where people go wrong. When you hear them use this language of father, 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 quite confusing. You know, there is father, there is total. When they use the language of total, everything becomes very easy for me. But this thing of father, a father, you have to be very careful. Be very careful here. Listen and listen to me very well. What are we told? We are told, ladies and gentlemen, here, that year 2, end of year 2, 40 left in the year. And another 50 are expected to leave in year 3. But you see, we're accounting for people who are going to leave over the 3 years. So some of you then must have forgotten the actual number that left in year 1. When they use this concept of father, father, then remember to always include the actual number of employees who left in the preceding years. So it means end of year 2, we had 40 who left in the year. All right? 40 left in the year. And another 50 are expected to leave in year 3. So these are only 2 years. What about this actual who left, in this case here, in year 1? Remember, for the previous years, you can only work with actuals alone. For previous years, you can only work with actuals. So then I'll say 1,000 minus 100 who left in year 1. 1,000 minus 100 who left in year 1, minus, ladies and gentlemen, the actual who will live in year 2 were 30. So minus 40 minus the 50 who are expected to leave in year 3. So minus the 50 who are expected to leave in year 3. So then what do we have, ladies and gentlemen, here? Could you kindly guide me? Could you kindly guide me? 810. 810. Thank you, and thank you so much. Now, year 3, I'm so sure there is nobody who will be able to get the number of employees left in the organization in the 3rd year. I'm 100% sure of that. Let's see. Let's see. Bernard already has a figure, but I can assure you, this one you can bet. Is there anybody who likes betting? Is there anybody who likes betting and we bet? Is there anybody who want to bet with Mwalimu here for year 3? We bet 1,000 bob. Today I feel like eating our students' money. Here there's nobody who bets. There's nobody who bets. You've lost something very nice because everybody would have gotten this correctly. Everybody would have gotten this correctly, including Bernard. Including Bernard, but he doesn't want to lose. Now you lose. So for end of year 3, we have 60 employees left in year 3. In year 3. So what I'll do for the preceding years, predecessors, what I'll do, I'll take the actual that left in year 1. I take the actual that left in year 2. I take the actual that has left in year 3. I subtract all of them from 1,000. So it will be 1,000 minus 100 minus 40 minus 60 minus 60 minus 60. So could you kindly give me this answer? Could you kindly give me this answer? 800, right? 800, 800, 800, 800. Great. So I can see Nima asking a very good question. Why are we not using the figures like we did for the other question? Is there somebody who can help me answer that Nima's question here? Is there somebody who can help me answer Madam Nima here? Why here are we not using the approach like we used in the other question? Is there somebody who is able to see the difference between this question and the other one? Because really that is where the difference lies. That is the most important thing. I'm waiting to see whether there is anybody who will be able to type here and tell us exactly, what do you think? What do you think? What do you think? Where's the difference between the two? Yes, Isaac has nailed it. It's because of total and the father. The other question, they were talking about a total number for the 3-year period. So they talk about a total number, you can't use the actual given in that year, right? But when they use the word father, father means over and above. You must subtract both, the actual and the father. You must subtract both. Bernard tells us because of the words additional as opposed to total. As opposed to total. So some of these things will become clearer as we get along. Thanks for asking that question. Now, ladies and gentlemen, after this, these are employees. So if they're employees, we need to change these to shares. We need to change these to shares. We know that each guy was promised how much? Each guy was promised how much? Each guy was promised how much in terms of share appreciation rights? In terms of share appreciation rights, each person was promised 100. So times 100, each person who will remain with us, was promised 100. Times, change this to money. When I want to change this to money, ladies and gentlemen, could you kindly talk to me tonight? Which fair values will I use? Remember, these are share appreciation rights. Share appreciation rights are the same as what your cash settled. So under cash settled, to make your life easy, am I going to use the fair value as at the grant date? Thank you very much, Bernard. It's supposed to be fair value at the end of each year. Fair value at the end of each year. Fair value as at the grant date is what we called hot air. No substance at all. No substance at all. right? So under share appreciation rights or cash settle the payment, we shall always use the fair value of the shares as at the end of each year, as at the end of each year, as at the end of each year. So as at the end of year one, we're told as at the end, so this fair value at the granted date is useless to us. At the end of year one, you can see, at the end of year one, the fair value of the share appreciation right is now 6. The fair value here is 6. The fair value here is 6. And then you go to year number 2. Year number 2, the fair value they have told us is 7. Year number 2, the fair value is 7. No, the fair value is 8 for year 2 and 7 for year 3. So 8 and 7. So times 8 times 7 times 8 times 7. Now, could you kindly do me a favor? Remember, always these ones must be time apportioned in accordance to the vesting period. Again, the vesting period here, coincidentally, is how many years? Is 3 years. So the guys who do this year will have, at the end of the year, will have worked for us for 1 out of 3 years. These guys here will have worked for us for 2 out of 3 years. These guys here will be the ones who will now vest like that. So then could you kindly give me these answers? For year number 1, is there somebody who knows 760 times 100 times 60 times 1 over 3? What figure are we getting there? Somebody for year number 1. What figure are we getting here for year number 1? So according to Bernard is very aggressive. Remember, AFR needs somebody who is very aggressive. AFR, unlike any other paper, unlike even advanced financial management, AFR needs somebody who really is at the keyboard, a keyboard warrior. You must talk to us. So 152,000. 152,000. How about year number 2? How about year number 2? How about year number 2? Year number 2, what do we have for year number 2? Martin tells me it's 432,000. Thanks, Abraham. 432,000. 432,000. And then lastly, what do we have here? Lastly is 432. No. Sarah, thank you very much. You're making a contribution for the second year. For the second year. So now we are on the third year. So the third year is 560,000. 560,000. So what I need to do, the last thing, is to come and get the change. So change, we have 152,000. Who can give me this other change here very fast? Second change. The second change, is there somebody who could be knowing what the second change is? Anybody who could be knowing what the second change is? Second change. I'm getting these figures from very few students, which is quite absurd, quite wrong, because I know most of the guys here, actually all of you are very bright. All of you are very bright. 280,000, 280,000. And then we have the last one. The last one, this is 560,000. 560 minus this, 560 minus this, 560 minus this, 128,000. And I know that always, regardless of the share scheme, these must always be debited to the expense. How about this? This in the balance sheet, this will be the total liability. Year number 1. Year number 2, the total liability will be this. Year number 3, the total liability will be this amount, right? And then, of course, for year number 3, when we pay, for year number 3, when we pay these guys, we shall come and debit the liability, and then we credit the accumulated cash of 560,000. And then we close that account. We close that account like that. When we pay at the end of year 3, these will be the journal entries. Like that. So I'll be sending you some 2 videos from our past paper questions. This is how we study here. It's quite a blended learning, right? So I do explanations on the main standard that now you appreciate. We have what we call IFRS 2, share-based, right? Share-based. which is quite different from the IFRS on pension. Very different. Very different. Right? Very different. Remember, pension is never pegged on the fair value of the shares. You can't bring pension arrangements, you start accounting for them under IFRS 2. So we have come to the end of this particular session, ladies and gentlemen. It's my belief that you have gotten something out of today's class, however small. And I would want to encourage you great students of ours to join our advanced financial reporting online classes. You've got two types of classes here. We have the normal class, and then we have the special class. I teach the special class which costs 5,000 Kenya shillings. But now remember, special class is not for everybody. Special class is a class of the students who are having retakes. Students who are having retakes, who attempted these exams, preferably when last semester, things are still fresh. So that for my case, what I'll do, actually, I'll not even be going through all this. My case is basically to attack past paper questions and giving you the high level knowledge that you need for you to be able to pass like that. But as you choose to come to my class, ensure that you are a repeater, in quotes. Nobody's a repeater in custom. But just ensure that you have tried this thing before and failed. Great. Otherwise, thank you. Thank you very much. Bye-bye. Be blessed.